Good evening, this is Ken at Tortoise Capital with a review of the weekend trading report for November 9th, 2019. The market is in bullish, quiet conditions. It is deeply overbought on each of the look-back periods from 3-day to 270-day look-back. Price with respect to the 200-day moving average is green bullish at 6.62. The ADX is neutral with a reading of 20, but with bulls in charge. Risk index is the 30-period moving average of the VIX divided by the 10. The boundary between risk on and off is 1.0. The current reading is 1.169. That's deeply into risk on. By looking back 5,000 trading days, we can compute the risk Z, which is right now at 1.58, abnormally strong in terms of lack of volatility, so extremely quiet, we should say. And you can see it's just starting to roll over at a peak on the 180-day histogram. That has always been a warning about a potential volatility spikes in the short term, so we're going to be respectful of that possibility. You can see the current standard holdings in the blended monthly rebalancing for each of the portfolios, and then the leading contenders in each of the portfolios based on closing prices on Friday. Notice the return of strength in technology in all the dimensions and finance, moving away from the defensive plays. ETF2 theoretical exposure is at 100%. I should say that the guys are working hard here at the boot camp, and we've been uploading some videos already to the annual coaching project and to the Dropbox repository for folks who have silver and gold memberships, so look forward to your review of those materials. We just completed an index for the October boot camp. I'll be sharing that around to gold and silver subscribers so they can zero in on specific lessons that they might be interested in. So look for that coming out on the Patreon site here sometime, not later than Monday. We're going to take a look at some market health checks now. All systems go in the monthly SPY, 3 months in a row of straight up at all-time highs. Market went into from summer to fall, back into the summer on MACD histogram. All the regression lines are sloping up until further notice. That's a good thing. On a weekly, the same basic thing, 5 weeks in a row up. Still early in the PSAR success string. The dragon continues to ride the rails on the Z+1. All the regression lines are up. MACD histogram is early in the summer on this next leg. So we estimated a possible upside move of 10 to 15 bucks on the basis of potential news items like a failure of the sham impeachment or a China trade deal, or further meltdown by the Democrats. This is a market that has the potential for a $15 move in either direction without much difficulty in terms of belief or justification. On a daily basis, again, you see we pulled back a little bit from the all-time high, but closed strongly on Friday and poised for further gains. A long string of over 20 days of success on the PSAR. We're deeply into the summer, well above the Red River, so that's the only cause for concern I have. This is a long in the tooth, third leg up in the bull, and there's plenty of narratives out there saying why it should cool off. But until further notice, it's all systems go. But protect your open gains with a respect for the potential of the downside. Quick look at the various blended monthly rebalancing portfolios, most everything on a buy signal. Japan continues to dominate. The leaders continued to lead, but it was you'll notice the lack of volatility in all those moves, with maybe the exception of finance, which did really well and looks like the strongest sector. That has to be because of all the billions that the Fed has been pumping into the cash system. So how long can that last? I don't know, but I'm mindful of how toppy XLF looks like, and I'm going to be prepared to preserve any gains in that sector. ETF 32, technology and finance have resumed their gains, and all the defensive plays are starting to sell off, including, somewhat surprisingly, the real estate, unless I'm thinking that there's got to be some potential gains in there And if the market were to get weak, there's plenty of room for the real estate to recover its defensive posture. Treasuries have sold off pretty sharply too, down quite extensively over the last time period. In the Dow 30, leaders continued to lead, especially GE. That's part of, I think, that finance pump, but they're still horrible, and I would be cautious with those guys. McDonald's and Cisco have started to turn the corner. McDonald's is trying hard to recover from their shenanigans. It's a must-own, so we'll continue to stock it. Disney had some nice rebounds this week as well. Sector spiders dominating with the aerospace and defense and healthcare services and telecom. Otherwise, the leaders generally did pretty well, except for the disappointment in home builders. Maybe that's tied to the slowdown in real estate. ETF Max, China, potential trade deal coming next week. Let's see. Japan, total dividend, really doing well. Technology and financials still standing out hard. The EFA continues to defeat the U.S. slightly. So EFA has just had some amazing moves, and we're protecting the swing trade in that sector. All the systems go with all 10 above their 4-month moving average, so that still keeps us at 100% asset allocation. In the sector spiders, strength is in technology and financials. And dividends in Japan still looking pretty good. Maybe a little slowdown here, as you see in the home builders are suffering. I'd be looking at stocking them longer term after they cool off. Shifting to the daily report, no signals in channeling an overreaction. 10-day max pain, still the usual suspects. I'm looking hard at Coca-Cola and Pfizer as potential stocking candidates. Dow tactical summary, plenty to choose from in the auto framers, and quite a few dojis were in effect on the really kind of quiet week we had all week. There were breakouts in Microsoft, which has been the stealth leader in technology and is still on my short list for continued positions. Breakouts in United Health and DuPont. In the ETFs, Brazil is right on the boundary of getting ready to crack in a big way. We studied that one pretty carefully at the boot camp, and that's going to be tradable, I think, in this week ahead. Lots of volatility ahead. Oil is poised to give a boost to energy, and so if finance and technology were to take a breather, basic materials and energy are certainly postured to be able to do well. You can see XLB had a breakout, and technology had a breakout this week. Lots to choose from in the negative Z stretches. McDonald's still is postured for interesting moves, and as well as Coke and Procter. Still a handful of good super pinch candidates ready to break out in either direction. Auto framer for those of you trade framing at home based on trade location, and the regression line fractal framework. I'm looking at Travelers and McDonald's as deep discounted value plays. I like IBM. We took a look at that in the trade framing workshop this weekend, so we're going to post something in the chat room and talk about it tomorrow. Lots of things to choose from on the daily squeeze, which is not really unusual given how little volatility there was. And nice to notice McDonald's, Home Depot, diamonds are all in there ready to move sharply. Right now I'm looking for the summer leaders to continue to work the best, and that's, so you're looking at materials, finance, and technology, and the diamonds are doing well. And then in the Dow 30, these early spring movers still have room to recover. There we are with McDonald's once more and IBM. So those are owls ready to go, and they haven't fully realized their potential. So if the markets do well, I wouldn't be surprised to see them playing catch up because they're deeply on sale. But otherwise, these this second group that are high Z-scores in the summer, Dow, ExxonMobil, Microsoft, and U.S. Steel, all postured to continue to do well on the basis of relative strength. Those are easy to believe in and easy to add to once we get going if the market goes up. multi-time frame NDX summary. Some harsh sell-offs in the defensive plays. Brazil, Latin America especially smashed hard. Silver and gold's weakness is playable inside wheat and precious metals, and so that's in a critical state that if the market gets weak, wheaton is postured to do well as a defensive play, but if the market does well and gold and silver continue to slide, wheat and precious metals is my way to play that because they're easy to short and they're very, very liquid. You can see just the unmitigated gains of the last 30 days in the S&P. It's now at 1.5 sigma above the long-term average. The slope of the RL30, that's the concern I have, is that thing is peaking at 1.5 sigma, and it's hard for it to get much better than it's been in the last 30 days with this lack of volatility. So I put all those things together and say, do not be surprised at one-day sharp volatility spikes to the downside this week. If so, it'll be interesting to see if it can last more than a day. So far, this market's been able to shake that off for the last 30 days, but if you get 2 of those in a row, then it's Katie bar the door to the downside, and a $15 sell-off's not out of the question. That's everything I wanted to cover in the daily report. There's a good speed run on the swing portfolio for the silver and gold members, where we took a look at the top 25 symbols of interest this weekend to really figure out how to apply the sense-making framework. So that's definitely worth your study for those of you in the subscriber sound of my voice. It's Ken at Tortoise Capital. Keep your risk measured and your powder dry. I didn't want to do that while you were working.